Hi, good afternoon. My name is Peter Lee. I'm here to talk about bonds and bond yields. We have about 15 minutes. In this pack, you should have a PDF with 4 pages of explanation together with a spreadsheet with some calculations. I invite you perhaps to pause the video while you get both of those open. Good, well, we'll start with some basic concepts. Bonds are a tradable instrument. That is one of the really defining features of a bond. It's something you can buy and sell. Bonds are debt instruments, so unlike an equity where you're buying a security that entitles you to dividends, votes, and a partial ownership of the company, with a bond you're entitled to cash flows, interest and principal cash flows that really are repayment of money that has been lent to the bond issuer. The original subscribers for a bond at the time it's issued have in a sense lent money to the issuer. Those subscribers may choose to either hold the bond to maturity or indeed to sell it in the market at an earlier point. If they sell it in the market, it may of course be at a higher price or at a lower price. So that's what I want to explore, just some of the features of bonds really, and this idea that the price can move. The bonds have a market price that can go up and down. So I'm going to pull up an example very quickly. In fact, let me do that right now. I'm going to pull up an example on the Bloomberg system, and then you'll see that this same bond we will be looking at and talking about in the notes pages you have. So I'm taking a German government bond here, a Bund so-called. I'm going to run through the details of what's shown on this page, the description of the bond, but I just wanted to start by showing it on Bloomberg, a system widely and frequently used by bond traders and investors in the market. I'm also going to show you straight off a spreadsheet that has come, as I said, with this pack. The purpose of this spreadsheet is really just to show you the basic calculations that go with a bond. And so what I've done in this spreadsheet, I've set out for this same German government bond the details of its cash flows, the discounting of its cash flows, the calculation of price and the specification of a yield. And we'll also be looking at how to calculate a price for a given yield, and of course vice versa, the yield implied by a given price. So let's continue where we were. Bonds are issued, what I've just been looking at is a bond issued by a government. Bonds are issued, however, by not just governments, although governments issue them in very large sizes and amounts. Bonds are issued by corporations, by state level governments, so municipalities and states and counties and so forth, depending upon which country you're in and how that country is legally organized. So I'm going to take here just a picture of that screenshot, and you can see in the handout this explanation of a lot that's in that screenshot. And I'm going to go down to here, and we're going to really go through everything that's in this picture. And you can see that I have annotated various of the numbers and features and descriptions with a letter, just to note what we're talking about. So, in the case of this German government bond then, I'm going to start by saying that at the very top left of the page you have a description of the borrower. So Deutschland Republic, and on Bloomberg each borrower has a short letter code, a ticker so-called, and in the case of the German government that is DBR. So in the yellow box at the top left, that's a short specification of which bond we're talking about. So DBR, and then the numeral 1 indicates the rate of annual coupon, which in this case is just 1%. Next to that, a date in month, day, year format. So that tells you that this bond matures on the 15th of August 2024. You can ignore the word corp. That is just part of Bloomberg's specification that this is a bond, not an equity. I'll go to the letter A up in the top center, and you can see there two numbers below the letter A. Those are the bid and offer prices for this bond. The bid price, the price at which a seller in the market could choose to sell bonds to a bond dealer, a major bank, investment bank, and so on, market maker. On the right hand side of that, the offered price, 101.5050, that is the price at which an investor would be able to buy bonds. You can see then next to that, under the marker B, two other numbers. These are the yield to maturity. We're going to talk a little bit about yield to maturity. The yield to maturity indicates what rate of return you could expect if you, for example, bought the bond at the offered side, a price of 101.5050, and held it to maturity. You know, if you were able to buy these bonds for exactly their face value, which we assume to be 100 euros for the purposes of all of these calculations. So if you were buying them for 100 euros and you got back 100 euros at maturity and a 1% rate of payment in between, I think you might agree it would be pretty straightforward that your effective rate of return, what we call the yield to maturity, would be 1%. I think it's logical as well to say that if the price you would be paying at the moment is above 100% of face value, then it is no surprise that the yield to maturity is a little bit less than the coupon rate of 1. The marker C, you can see that coupon is 1%, as I have already mentioned, and that in the case of German government bonds, the coupon is paid annually. That is not the case with all markets. In, for example, Japan and the USA, United Kingdom and others, coupons are paid twice yearly, semi-annually so-called. Marker D, well, the bonds were issued at a price actually a little bit below 100. This is not uncommon. There's a lot of negotiation that goes on, and indeed an auction for government bonds where a price is set. People have detailed tastes and needs for yield. However, it is customary for the coupon rates of bonds to be in reasonably round numbers. It therefore follows that the issue price, if you think about it, will not necessarily be, or not exactly, 100. Just below there, next to the marker E, we have some dates. The dates, for example, upon which the issuance of this bond was announced, the 2nd of September this year, and dates 10 days or so later upon which the bond became, if you will, live. It became a bond that can be delivered and transacted and so on. In between those dates, there will have been an auction by which the German government sold these bonds to market makers and dealers principally. I've shown here next to the marker F some identifying numbers. These are important for bonds. These identify the particular issue. I won't go into much more than that at this stage, but I think it's worth flagging that they are important information. Below there we have the credit ratings. AAA is the highest credit rating a borrower can have. It is helpful in the case of government securities, and a little later we'll be talking about their role as benchmarks briefly, but more so in later modules. It's helpful for a government security to have a high credit rating, and this is the highest you can have, AAA. Next to the marker H, I also point to the size. You can see this is a 14, well, it shows 14 million then there, and then the letter M at the end. That indicates 14 million thousands. M is millions in the case of bond markets. So that's a total issue amount of 14 billion euros. So a pretty large bond issue. I think it's worth having some discussion about the idea that market values for bonds change. This is a very important point. We've seen, for example, a moment ago, a bond that was issued at a price below 100 and now has a market price of around 101.5. Something has changed. Indeed, in the month or so since this bond was issued, there has been something of a change of atmosphere in the German and other Eurozone bond markets, where people are becoming more concerned about risk of deflation. In those circumstances, it's not too surprising that yields have fallen, and that has been the case. What we do in markets is we track the yields of various bonds, various so-called benchmarks. The one we've just been looking at is approximately a 10-year bond. And indeed, it is currently what the German government market would call the 10-year benchmark. The most actively followed, the most actively tracked bond of that maturity in the current market. It provides a marker, if you will, from which other, for example, corporate bonds are priced. The pricing of a corporate bond will often be specified or discussed in terms of a spread over the yield on a government benchmark. So the pricing of a corporate bond market in euros could easily be discussed or specified as 10-year German governments plus 50 basis points, 0.5%, for example. I've shown here in the handout a yield curve. In fact, in spite of the two lines shown, this is really only one yield curve. This is the German government bond yield curve. The line in green is. And the line in yellow is in fact the same thing, but how it looked a month earlier. So 31st of October 2014 is the green line, and the yellow line is, as I said, a month earlier. You can see that at most maturities, the yields have fallen. Let me just, before saying much more about that, just quickly specify the x-axis on this yield curve is, of course, the term to maturity in years. So you can see it is labeled at the bottom here and runs from 1 month all the way up to 30 years. The y-axis, the vertical axis on the upper part of this diagram is the yield of the various benchmarks in the German government bond market. And you can see this is what people would refer to, in fact, as a positive yield curve. Positive meaning it slopes from bottom left to top right. When you think about it, that is kind of natural, and it is called a normal yield curve in the market. Natural because, well, longer bonds do in several respects, not least, for example, credit risk, present greater risk to investors than do shorter bonds. Longer bonds, if they present greater risk, could be expected to attract a higher rate of return for investors. It might also be said that human beings prefer to have access to their savings or wealth, whatever you call it, sooner rather than later. We need an incentive to invest for longer. And you can see the bond market typically provides, and this is typical what is being shown here, typically provides such an incentive to invest your money in a bond, to lock away your money for a longer period, does tend to give you a higher rate of return per annum. I wanted, towards the close of this presentation, just to highlight something else, which is just the idea, not only that bonds trade, but the relationship between yield and price. Here what I've done is I've taken from Bloomberg exactly this same bond that we've been talking about, and I've shown the evolution, if you will, of its price over the period since it was issued in September of this year, a period of 2 months or so. And you can see there has been some volatility, some price movement. Nothing enormously dramatic, but consistent with what we saw for the yield curve. Bonds have mostly gone up in value. You can see an upward trend here. I wanted to emphasize at this point the idea, and if you compare these two diagrams, they do appear very similar, but in a sense opposite. And they are. I wanted to highlight the idea that if we looked at the evolution of, or the history of this bond in terms of yield rather than price, we would of course see a picture that looks the same but in inverse. The higher the price you pay for a bond, as I have already indicated, the lower the yield. If you pay a higher price for a fixed set of cash flows, it will of course imply a lesser rate of return. I switch now just to the spreadsheet I momentarily showed you earlier, and towards the closing of this presentation I would encourage you, if I may, to do the following. Alongside the materials you downloaded, you will have had a brief set of instructions on how to operate the solver in Excel, which will be an important tool going forward in later modules and is an important part of what we do here. What I've done in this spreadsheet, you can see I've set out the details of the bond we discussed. I've shown the price and yield. I've also shown a dummy purchase ticket where we are actually buying some bonds. And what I've then done is, just back on the calculations tab, I've shown how we perform calculations of yield to price and price to yield, how we set out the cash flows, and how we calculate the term to each payment. We will add to this spreadsheet in later modules when we come to look at sensitivities such as duration, modified duration, DV01, and convexity. Thank you very much for your attention, and see you on later modules.